All right, Benny, welcome to Beers and Buying. Let's start it off like we always should and give it a, oh, yes. What a sound. First one of the day, of course.
Nice and crispy.
Mm-hmm. But here we are back at Beers and Buying. Today's guest is Mr. Ben Walker from Inspire Accountants. Mate, obviously you've had me on yours before, on your podcast. I can't remember how long ago that was, but thought it was only good for me to return the favour, and obviously I feel like you'll be able to add a lot of value to the listeners and to our clients as well. So, mate, thanks for coming on.
Yeah, thanks for having me here, and good to be able to share.
Awesome, mate. Now, I just thought we might start out and give a bit of a landscape around kind of Inspire Accountants and what it is, and I think you guys we were talking about it before off air. You celebrated almost 10 years in business, which is a massive accomplishment in itself. But kind of just take me through Ben Walker, where you started out from, because obviously I think you might have been working for one of the big four beforehand, but just take me a little bit of a journey of Ben Walker and how you started and kind of where you are at the moment.
Yeah, cool. Alrighty. Well, I started in a big four accounting firm back in, it was 2007. I was straight out of school, actually. So turned 18, year out of school, and I got what's called a cadetship, which is basically undergrad, no experience, and they train you up from there. So I was fortunate enough to be in a team in the big four. It was like the smallest size clients in that division, but it was even the smallest within that subdivision. And I thought it was a cop out. I thought, I want to work for the big clients. But turns out it's been awesome, because it's the exact experience that I've had all throughout the other accounting firms I've worked for, and I resonate with it so much because our client base is small business owners. My dad ran a catering business. It's a small business when I was a kid, and even my grandfather. Take a heap of learnings of what he did. He started a removalist business and set that up over decades to be something pretty cool. So can relate to the struggles and the battles of small business ownership, and started Inspire back in 2013. So it's been coming up to 12 years now, actually.
Wow.
Our client's been that small business owner, definitely love helping out that segment of Aussies.
So there's a span of about 6 years there that you're working for, roughly, I would say. 5 years maybe that you're working there for the big four, just churning your way through. What was there like a light bulb moment that we were like, maybe there was plenty, or was there like a light bulb moment where you went, you know what, I'm going to go and start my own business? Yeah,
pretty much. So I had 3.5 years with Big Four. Then I went to work in a suburban firm, and I had 2.5 years there. Through that time, I got to work a lot closer with the clients, because at Big Four, if you're pretty junior, you never see the light of day pretty much. They keep you locked in the room. And but at that smaller firm, I also got to see not only the client relationships and how that worked, but also the operations of the business as well. And that sort of fascinated me as much as the client work did. And it would have been it was 2012. I was coming up to a bit of a point in my career. I felt sort of stale. I wasn't sort of learning a heap more. And I wanted to I felt like I wanted to have a crack. Xero, the software with an X, was coming out for small business owners at that time. It had been out for maybe a year or two before then, but it was starting to get a bit of a name for itself, and I wanted to ride that wave. I worked out, do I want partnership in the firm I'm at, or do I want to have a crack by myself and see what it looks like? And I felt I had a bit more control over what it would look like if I did that. So, it was the first day back in just after the Christmas break in 2013, and I broke the news to my boss saying, "Hey, I'm keen to start my own firm," and just basically have a crack. And I think it was 23 at the time, and a lot of water under the bridge from then to now.
Yeah. And so, just correct me if I'm wrong here, but I think I know the story. But when you first started out, was it just you and your sister?
Yeah, well, even for the first month or so, it was just me.
Yeah.
And I found myself doing, everything from the actual work to the admin to, trying to do the marketing stuff and wearing too many hats, like small business owners do. And then I thought, I need someone. So I hired my sister in that sort of administration position.
Yep.
And then, within maybe about 2 or 3 months, I'd hired my first accountant because, in those first few months, I found that, I started the business. I let people know about me starting it. And I had a lot of friends and family change over to me. So my growth rate was quite crazy in those first sort of, call it 3 to 6 months. And I definitely needed help throughout that time. So.
Yeah. No, that's unreal. And then so from there to where you are today, I think once again, we're talking off before, but like how many have you got in your team as at today?
There would be, let me count basically in my head, about 35-ish in the team now.
Unreal.
So, yeah.
Big operation now.
Yeah, definitely.
Got to deal with HR and all that fun stuff.
There's often a few jokes about that.
Yeah.
We don't take ourselves too seriously.
We at Arch, we always call Brad the head of HR.
Oh dear.
Because he's always the one in trouble. But anyway, that's all right. That's all right. So look, and the reason that I ask those questions to start out, mate, is just to give a bit of a landscape around, obviously your expertise and your experience with, I guess, all different people in life. Like, obviously, mainly your business owners, but sounds like earlier on, maybe you're dealing with a lot of the mums and dads as well, in terms of doing individual tax returns and stuff like that. You're probably a bit further away from that now.
Yeah. So our core client is a small business owner. And that usually is like a company or trust that runs a business and mum and dad's tax return as well, and how the income comes out of the family group. Some of our clients have investment properties, whether it's, individually held trusts, some of them companies, and even self-managed super. So we cover that whole spectrum, if you call it.
Yeah.
But the core that links, 95% or more of our clients is that they run a small business, or they've, some of our clients have recently sold and exited, but we still look after the requirements around the investment side of things.
Yep. You'd help with the strategy around that as well, right? Like, so someone out there that's maybe looking to sell their business into the future, like there's different strategies that you can potentially put in place so they're not absolutely smashed with tax.
Yes, yeah. There's tons of small business CGT concessions for small business owners selling, and they say small business CGT concessions. They're very complex how they apply, but it can mean, given the right conditions, people could sell for millions of dollars and pay $0 in tax. Yeah, like it's if they're understood and implemented perfectly, they can be really helpful.
And I think that's why it's probably important to find the right accountant with the right expertise, because one thing that I've probably seen in my time in mortgage broking is, there's all these different fields of accounting, and even like depending on the business, whether it's, there's livestock involved and it's rural, like there might be a particular accountant for that. And then, there might be, for your day-to-day business owners, there can be a different accountant. So it's probably right to get yourself synced up with the right person, right?
Yeah, for sure.
Yeah.
There's definitely people with certain niches in industries or type of client for sure.
Yeah. And so, mate, one of the main important reasons I wanted to bring you on, particularly talking about property, is I know that we've had a lot of clients that have been hugely successful, whether it's, buying into developments and doing really well, or, the self-managed super fund products that we've been able to put people into, whether they're business owners moving into that, property. So kind of just wanted to peel all that back and have a discussion around it. And what I thought, maybe we'll start with just the normal residential property with people looking to invest. Did you want to give us a bit of a rundown around why someone, particularly that maybe is looking to grow a bit of a portfolio, would start to look to buy into something like a trust or a company as opposed to maybe in their personal names? Like, what would you kind of be your breakdown around why someone would do it that way?
Yeah, really good question, and that's often one that pops up for us when clients are looking to buy property. Is what entity does it go into? With like the easy option, the most simplest is in your own name.
Yeah.
But that can come with downsides. So the downsides, and this is what the trust helps solve, is that let's say that property down the track becomes cash flow positive and starts creating taxable income in its own name, in the property in its own right. then if it's held personally, that income has to get taxed in that person's name. Even if it starts out negatively geared, where it creates a tax loss, that might be a good thing for a high income earner.
Yeah.
But let's say 10 years down the track, that property is now producing 10, 20, 30K of net taxable income. And if that property is owned in a person's name where they're in the highest marginal tax rate, you're losing almost half of the profit that it makes to tax.
Yeah.
If it was in a trust, though, each year, when you do the trust's, what's called a trust distribution minute, you decide who gets the income in the family group.
Yeah.
And so let's say you've got the choice between a working person who's earning 200 grand a year,
Yep.
they're in that highest marginal rate. Let's say the spouse, for whatever reason, let's say they might be at home, not working, raising the kids, for instance, and they're not earning any taxable income so far. You could actually give them the income from the trust that year. But
Yep.
if they swap and the next year, you can actually change each year who gets the income. It's also very relevant when you sell the property as well. So when the trust makes a capital gain, you can decide who gets that.
Yeah.
Versus if it's in an individual name and you make a 200, 300, 400 grand capital gain, that's going straight in the name of the individual and just
Yep.
boosting their already ridiculous tax rate.
Yeah. Yeah. And so correct me if I'm wrong here, but so if you've got a trust, you've also got a bit of flexibility, right? Not just, maybe it's maybe there's an ability to distribute to mum and dad who are retired, or we talked about before, just if it's going to maybe the wife that's raising the kids, but that it kind of gives the flexibility to distribute that as you need to, right?
Yes,
Yep.
absolutely. There's some rules around who can get the income.
Yep.
Even retired parents, about 1 to 2 years ago, there's additional rules that got in about parents receiving income.
Yep.
The gist of it is the cash needs to go to them. So whoever the trust
Yes.
distributes on paper, if it's not you or your spouse, it's got to be paid to them in a bank account.
Yeah.
And,
Not just paper.
That's right. Yeah,
Yep.
yeah. That's what the ATO are having a good go at. And even things like, I'll give you 10 grand, you give it back to me. Yeah, you can't do that anymore.
Yeah.
If that was the previous strategy.
Yeah.
So, none of that. But at the end of the day, there's plenty of people who support their parents. And if you're doing that, you've got to trust, then go for it. The other thing I might say to trust as well. So the reason why we use them a lot with small business clients is because there's usually other entities in the group as well. If you think, the interest rates are quite high at the moment. If you've got a highly leveraged investment property, and so I say high compared to a few years ago, they're not ridiculous in the scheme of things, but there's a lot of investment properties that are negatively geared when you consider the rental income, less depreciation, interest, all the costs of running that.
Yeah.
So they're making tax losses most of the time, again, for highly leveraged. Where you've got income against a individual name, that's handy. If you, let's say you've got an employee who works, they're in the top bracket, that's great, especially while that's the scenario. So high income and this negative gear is reducing that taxable income.
Yeah.
But where you've got business owners, where you want that flexibility from a, who gets the income perspective, you may not want it in the person's name, because if you sell it later, you're going to get taxed through the roof. But with business owners, you often have the business itself earning income through a trust or a company, and you're able to get the same negative geared benefits. What I'm trying to say is with trusts, they're often beneficial for business owners where you've got other entities that can give that trust income. But with, let's say, 2 employees where their income is only in their own names,
Yep.
trusts are less effective.
Yeah.
So it may not be the best option if you're not self-employed. And that's why I think it's important before you purchase a property, an investment property,
Yeah.
to get advice from an accountant of what will give the best tax outcome.
Yeah. And you're right, because, and this is often not to say that we're pushing anyone away from investment properties, because it's very much the opposite at the moment. But a conversation that I have to people is just understand that at the end of the day, based where the interest rates are at, based on what you'll get on a rental yield on a property at the moment. So let's say on a good day, let's say you got 5%,
Yep.
but your interest rate is 6.5%. just got to understand that there's a shortfall there. So yes, there's some negative gearing benefits there, but there's also a matter of like from a cash flow sense, you got to make sure you're able to cover the difference on that as well, irrespective of if it's, you know, on the proviso maybe you're using equity from another property and you're fully funding an investment purchase, which maybe we'll just have a touch on really quickly as well. But from my standpoint, it's like even if we've got interest only, there still needs to be some form of a top up there. So you just got to make sure from a cash flow sense, you've got enough money that you can actually tip in to, you know, make the purchase happen and be able to take on the ongoing costs. And so one thing I just touched on there was equity plus, you know, fully funding the investment purchase. Did you maybe want to touch on some strategies in terms of if maybe particularly if someone's got owner-occupied debt, you know, what, obviously we're talking general here and we're not giving anyone any certain advice, but did you want to give some thought as to how you would view that?
Yeah, for sure. So the concept we're sort of touching on here is debt recycling. The idea is that you're you're maximizing tax deductible debt and minimizing your non-tax deductible debt.
Yeah.
So if I was to buy an investment property, for instance, and I've got equity in my own home, but let's say I've got a lump of cash as well. So my options could be put a 20% deposit plus stamp duty, you know, out of my own cash, or do I leverage equity and essentially loan that 20% plus costs? The answer, or the thing that aligns with the debt recycling, so you're maximizing your tax deductible debt, is literally borrowing 100% of your property value plus your stamp duty and keeping that deposit cash you had or you could have used, offsetting or reducing your interest on your non-tax deductible debt. So yeah, that's a concept that I absolutely appreciate and think is a good thing. You know, I guess at the end of the day, your effective interest rate after tax is what you're looking at there. So on your own home, for instance, if you could, you've got to earn, let's say you're paying 6% interest on that. You've got to gross that up for how much you have to earn before tax and call that about maybe 10% less 40% tax rate.
Yeah.
It equals your 60%, your 6% interest versus on your non-tax deductible, on your tax deductible debt, your after tax rate is that 6%. So it's a lot less cost of funds and you pay down your mortgage on your own home a lot quicker. So yeah, that's
awesome. All right. So the other one probably is at the moment, which we see a lot of, is self-managed super fund lending, and we could go down a pretty big rabbit hole here, which maybe we'll do.
Yeah.
The really common one that kind of I see from my perspective with accountants in particularly Inspire would be people purchasing a commercial property for their business to move into through the self-managed super fund, which the business then rents back off them. Did you want to kind of just take us through that, a bit of that strategy and what that looks like and and kind of what the normal advice might be around someone looking to implement that strategy?
Yeah, for sure. Yep. So with a self-managed super fund, that's the only way that you can use your own superannuation to buy direct property. And so, you can buy residential or commercial property. There's no restrictions on just being commercial, for instance. But the difference is with residential property in an SMSF, you can't rent it from yourself. So you can't buy your own home to live in your self-managed super fund. That'd be
the old holiday home and
but even
who's
then,
staying in it? No, I'm joking.
Wink, wink. That's technically naughty, but with a commercial property, you can own or occupy that with your own business. So, and we've got plenty of clients who want that security around owning their own commercial property, their premises, and so they use their super to purchase that. And again, this is through having years seeing this happen. Like there's even lenders who lend 80% of that stuff now. So you need a 20% deposit plus your closing costs on it, which at the end of the day, for a $2 million property, I reckon you'd be able to close that with $500,000 super. Is that
exactly? Yeah. Spot on. Yeah.
So, it gets pretty decent, and then you're paying rent from your business instead of to some third party landlord. You're paying that to yourself.
Yeah.
And even the requirement is you have to be market rate rent. You can't just pay obscene amounts of rent to your own super fund.
Yeah.
There's tax benefits to that, so there's an incentive for people to do it, but you can't. You got to pay market rate, and same thing, you can't go lower than market. You have to get appraisals on it. But again, you're paying rent to your own wealth creation vehicle, so that's why it's quite appealing. And even we've got clients who, there's nothing stopping you, for instance, prepaying rent. So as a small business owner, you can prepay up to 12 months of something to get a tax deduction. And so sometimes people use it as a tax planning strategy of, dumping 12 months worth of rent in before 30 June, claiming that next year of rent, but then the super fund gets that and is able to pay down debt on that one.
Yep.
So, and again, you've just got to make sure they're market terms, market rate, and it seems to work quite well.
For anyone that's listening out there that might be looking to invest within their self-managed super fund, whether it be commercial or residential, is there like a kind of a bottom line in terms of like what you'd like to see a super balance is, or?
So if you Googled how much do I need to set up an SMSF, I'll use this analogy, it'll say between 200 and 250K. Now, I've probably been saying that for about 10 years now, so adjusted for inflation, it's probably a bit higher.
Yep.
But the idea is that figure is given from where you compare the generally fixed fees of running an SMSF, and I'm talking about accounting, so our fees and just the general stuff, which is usually 3, 4, 5K a year, depending on what the fund is doing.
Yep.
When you compare that to the usually percent-based fees that a industry super run. But most of our clients, where they have SMSFs, they've got an SMSF because they're doing something different with their super. Generally, that is direct property.
Yep.
So when you overlay that into it, like if a client came to me and said, I want an SMSF, I've got 20 grand in super, it's going to cost more than 10% of their balance to set it up. Like that's silly. But if someone came to me with 100K and said, hey, I want to buy a 200 grand commercial property, it's a unit in, and I had this exact example, in the sunny coast, they had a small office there and they wanted to buy that. You'd need less than 100K to settle on that with borrowing.
Yeah.
So it made sense. And while I'm not a financial advisor, I can't say, yes, you should or yes, you shouldn't. I'm an accountant. I've got experience in SMSFs. And if a client comes to me saying, I want to do X, Y, Z, I want to set up an SMSF, there's nothing stopping me from implementing that request. And I mean, I wouldn't do it if it sounded silly. I'd just say, look, I just don't want to be involved in this. But if it makes logical sense to me, I'm not going to stop or say no to that. So, yeah.
Even just maybe to touch on something that might spark conversation here, but like let's say someone did only have 20 grand in their super, but they had these forward brought concessional contributions that they hadn't necessarily utilised.
Yeah.
Did you just want to touch on that really quickly around what that potentially could look like for? Let's say it was a couple.
Yes. Yeah, good point. So I think it was back in 2019, the rules changed around concessional super contributions. So that's the tax deductible super contribution limits. Now the limit has changed a few times, but at the moment, the current year we're in, it's 30K per person per year. But from 2019, where the limit was 27.5K per person, you could carry them forward, carry your unused limits forward.
Yeah.
And where you've got two people, that can easily become $250,000 if you carry forward 5 years, plus you can use your current year on top. So it's essentially 6 years of contributions.
Yeah.
And for a lot of small business owners, when cash flow is tight, they often don't pay themselves super. If they've got trusts, for instance, where you don't have to pay super on your own distributions.
Yeah.
So for clients where, let's say it's a big cash flow year, or they want to just catch up on the contributions, do a strategy around property, you can literally dump quite a bit of money in one hit. And yes, the answer to if someone has a very low balance, but they're wanting to very quickly ramp that up, again, that's a scenario where it makes sense that the client has an idea of what they're trying to do there. They've got a strategy behind it, and we'd press the buttons to make it happen.
So in a nutshell, what you're essentially saying is, whether people pull it out by equity or they've got the cash in their personal name or whatever it might be, in 1 year where you might have only had 20 grand in super, you might have been able to turn around and dump 250 grand in,
Yep.
which all of a sudden then forms your deposit, which then can then go towards purchasing, that commercial or residential property, whatever direction you decide to go in. One thing that's really interesting, and I don't know whether I've ever told you this before, but what the lenders would typically do with a self-managed super fund lending is like, okay, let's get 2 years worth of contributions, kind of like self-employed in a sense. PAYG, it's a little bit easier. Not to say that we see a lot of that in the self-managed super fund space, but what they would typically do for business owners, and they go, okay, let's get 2 years worth of contributions, either average them out or they take the most recent year if it's a bit lower. There's a couple lenders out there now that will actually just take on the last 12 months in terms of being able to service what are you actually able to borrow based on your contributions and the rent that you're going to receive on that property.
Yep.
And so what's really interesting is, there's some lenders out there that people could just go and dump a lump sum in that you can then go to look to actually service that loan. So, there's a lot of flexibility in that space where maybe there probably wasn't that, I would say, like 18 months, 2 years ago. So for anyone out there that's listening that maybe doesn't think they have enough super, but there certainly is a couple of levers that you can pull to get there. So
for sure. And I feel like it's super appropriate where people have a bit of excess cash. And the way I look at it with commercial property, where there's a will, there's a way. And in terms of especially inside super, you've got so many ways to get money in there. You've got the tax deductible way, you've got a non-tax deductible way where the limit's much higher. It's 120K per year at the moment.
yeah, well,
and especially like, let's say if you just got an inheritance of $1 million, I mean, that'd be a pretty good situation.
might not need us.
Well,
Property these days, maybe, you will need us.
yeah, exactly. But let's say you want to get a big proportion of that in there. There'd generally be a way to get that in there pretty quick, especially if you've got you and a partner. It can kind of speed things up because you've got two sets of limits.
And maybe just want to school us on this, but what's the difference between, let's say, if you wanted to buy like a commercial property in self-managed super fund as opposed to setting up like a new corporate entity to then go and buy that property? What would be the driver of advice around that? Obviously, it depends on the individual, but
yeah, well, one of the considerations is what ties up your servicing, and I think this is a point where you can talk to. Where my understanding is, doing it in an SMSF, you're not affecting your outside of super servicing capacity.
Yeah,
and that's a pretty good deal there, especially if you're buying it for commercial property to rent it to yourself. You're not going to do that every year. You're not going to have multiple properties unless your business needs it.
yeah.
So to me, it makes sense if you're doing commercial owner occupier. Very likely SMSF is the way.
Because I guess if you've still got to then, obviously depending on the gearing on that entity, but that money's then got to potentially flow somewhere else, right? In which you're potentially then paying the company tax on that. Is that right?
Yeah. Well, let's say you buy it in a company or a trust. This is so superannuation tax rate's about 15% as you're growing your balance.
Yep.
Outside of super, in a company that just invests, like let's say it's just owned that commercial property, you're looking at 30%. So it's twice the rate.
Of course.
So if you think over 10, 20, 30 years of ownership of this property and the compounding effect of that tax rate difference, it's going to add up to significant amounts of money, in your retirement.
Yeah.
If it's held personally or through a trust where you're taxed personally, you might be paying tax at 34 cents, 39 cents, somewhere there, which again is even higher than the company tax rate. So, it's a very low tax environment, super. There's more rules and restrictions around it for sure. But again, I think, it's sort of a game of chess, I feel, how you move your cards around. There's tax considerations, your serviceability. Because imagine you own your own home, you might have a mortgage on it. You want to buy your commercial property, have a mortgage on it. And then let's say you want to buy an investment property soon after. If you lock up your serviceability by buying the commercial property outside of super, you're shooting yourself in your foot.
Yeah.
So, I just feel like, it's a better outcome.
One of the other things that I wanted to touch on was just CGT. Obviously, I think that term gets thrown around a lot, so I thought we could just maybe break that down for anyone that's not listening. It's capital gains tax. But can we just talk about what that rule usually looks like, whether it's, obviously with owner-occupied, maybe I'll let you answer this rather than me give advice on this, but if you've got an owner-occupied property, I know a lot of people go, oh, what about the capital gains on an owner-occupied property?
Yeah.
And then also, not that that's probably a non-issue, but you can touch on that anyway, and then just the investment side of it, particularly what the tax looks like, and then potentially what benefits you may get depending on how long you've held the property.
Yes. Yeah. Okay. Cool. So yeah, capital gains tax. If you own a property that you live in, so you've bought it as your home, and you sell it, even if it's like quadrupled in value, you sell it, you walk away capital gains tax free. Now, with your own home, there's also another rule that's not too well known. It's called the six. Well, I don't know whether it's got a name, but we call it the 6 year rule. 6-year. And what that means is if you buy a home and then let's say you move out of that house and rent it out. So it turns into an investment property.
Yep.
We've had this with clients where they go around traveling the world and they come back later. But you move out, you've got up to 6 years to sell that property, even though it's turned into an investment property, to sell that and treat it as capital gains tax free. The rule with that, though, is you can't claim the same period of house ownership on more than one property. So let's go to another example. You don't travel the world. You own your first home. You live in it for a few years. Then you rent it out for 5 years, let's say.
Yep.
But when you rented it out, you bought another home. And so now you've got your new home you're living in plus your old one you've turned into a rental.
Yep.
So you can't go and claim the CGT main residence exemption on both at the same time. So that's the trick with that one. Now, you don't have to make the decision until you sell your first one.
Gotcha.
So, or either of them, of which one you want to apply. But let's take the first house as an example. So let's say you bought it for $500,000. It's worth $1 million at the time you rent it out, and then you go and sell it for $2 million later. So it's grown $1 million while it's been an investment property. But a $1.5 million since you've owned it. If you were to not apply that exemption, you'd only pay CGT or capital gains tax on that $1 million while it's been an investment. So you do get that sort of proportion. And so what I usually tell clients is if you change your home into an investment property, get a valuation done at the time you change its use. So you've got that on record for later. And then you can use that to make your decision around which home you apply that on.
Would you typically tell someone to go and get a valuation at that point in time as well, or do you kind of wait until the potential sale and then the valuer can backdate? Oh, I've just seen that in the past with...
Yeah, where they haven't got a val, you can get, I don't know whether they're valued.
Like a backdated val almost, yeah.
That's right. They look at comparative sales around the time that your change of use happened. So that is a backup as well for that. But let's say you don't have that main residence exemption, which is a fantastic exemption, and you've just got an investment property that you bought, made a gain on, then if you own that property for more than 12 months, you get a 50% discount on what you pay tax on. So let's say you make $1 million of gain. You buy for $1 million, sell for $2 million.
Yep.
If you own that property for more than 12 months, you pay tax on $500,000. If you own that property for less than 12 months, you pay tax on the full $1 million gain.
Gotcha. Yeah.
At whatever your tax rate is in whatever entity it is. So that's the sort of thing you've got to keep in mind. Now, I might just say, companies don't get that 50% discount.
Yep.
But trusts can pass on that 50% discount to the beneficiaries. And if you own it in your own name, you do get that 50% discount. So, yeah, that's what you've got to be mindful of.
And so that, once again, that leans into the importance of setting up the structure right initially. So whether it's like what you're essentially saying there is if someone's got an intention of buying a property, making some good money on it, hopefully in the future, and then selling it. Like, so let's say someone bought a property off the plan.
Yes.
And they made a truckload of money on it from, the value of that property going up. Your advice, just once again, correct me if I'm wrong here, would be you'd buy that in a trust as opposed to a company because of the CGT potentially? Like, let's say they held it for 12 months?
Generally, trusts are the go-to for property.
Yeah.
It's where you've got where we look to invest in property in companies is usually with very high income family groups.
Yeah.
So where their family income across all their trusts and companies is above $500,000 a year.
Yep.
And that's where you get other issues which we won't go too deep on, but company loans and Division 7A and all this sort of drama you get associated with it, it makes sense, or there's an argument to own property in companies and forego your discount, forego your CGT discount, because there's just so much profit that you want to be able to deal with at a company tax rate.
Gotcha.
Not your 47% income tax in your own name. So
gotcha.
Yeah, that's where we start looking at companies.
Gotcha. Okay, so there's two main other points that I wanted to touch on with you, and one of them would be for anyone out there that's potentially looking to invest in property.
Yes.
So buy an investment property. Would you mind just breaking down really quickly the difference between brand new and existing, more so from like a tax perspective side of things as to what you can write off, particularly in those earlier years?
Yeah, for sure. So in 2017, I don't know who brought it in, but I'm assuming the goal was to put more investor funds towards new properties, so to fuel the construction industry.
Yeah.
But the rules change with depreciation. So depreciation is where you can claim a % each year of fixtures, fittings, the construction cost, and all that sort of stuff of an investment property. Now, before 2017, whether it was new or old didn't make a difference. You could claim the same rates, the same, there was no differences.
Yeah.
After 2017, I don't know what the date was. It doesn't really matter now. This is for properties purchased after that date. You can only claim the cost of the actual construction of the stuff you can't easily move. So things like the walls, the concrete, the slab, which is a good portion of the cost. Like if it's $1 million build, I mean that's a decent build. But what you look at is you claim that over 40 years. It's 2.5% a year.
Yeah.
So that is available to new builds or existing like secondhand houses that you buy. The bit that's now not available to that secondhand or non-new properties is the fixtures and fittings. So air cons, carpets, appliances if they're built in, things like that. So if you buy an existing property, you can't get that whack of depreciation on your existing assets. But if you buy it, put stuff in it, like let's say you fully furnish an apartment to rent, if you install the furnishings, etc., you can claim your depreciation on that. So what that usually means for new purchases as investments is you get a lot more depreciation, especially in the first sort of 5 to 10 years of ownership. And that usually translates into more tax savings. It's more negative geared over that sort of short to medium term.
Based on almost like that paper loss, yes, obviously people have paid for that, but it's not necessarily I guess it is an expense, but it's not something that people are forking out year after year, really, is it?
That's right. So it's a non-cash outlay, but it comes back to you in tax deduction. Yeah. And I mean, there's pros and cons about new versus existing. It's hard to find new stock, like new apartments or houses, or you've got to build and take risks with builders. Existing is a lot more known. It's easier, but you don't
potentially more capital growth.
Yep. Absolutely. So it's a bit of a trade-off. But if I had two similar performing or the exact same performing properties, one was a new build and one was existing, that was side by side, same numbers, I'd take the new build because of the tax benefits for sure.
Awesome. Okay, and the last thing that I want to touch on kind of before we wrapped up, and I always say last one and then I usually another few things come out, but the last one, we were talking about this off air. I thought it might be very advantageous, particularly for business owners, for us to have this little discussion around ATO debt.
Oh, yes.
Now, we help people from all walks of life, and whether it's a simple refi or people buying their first home, or maybe we're debt consolidating because we're rolling in something like a tax debt. Thought it'd be really important for us to just have a quick discussion around the potential changes that are coming in, for any business owners out there that may have some tax debt. So do you just want to run through what those changes look like?
For sure, yeah. So 1 July 2025 is the date that interest paid to the ATO is no longer tax deductible. So it was I think it was announced sometime in the last 12 months.
Yeah.
But it takes effect, 1 July 2025. And what that means is if you owe the ATO, let's say 100K, currently, as we're talking right now, the interest rate is about 11 point something % that you will pay on your ATO debts. That will turn into non-deductible 11 point something %, which means if you look at the pre-tax percent, it depends on what your tax rate is.
Yeah.
But ballpark about 17% effective tax rate. So it's ridiculous. I don't know. I think the policy was aimed to reduce ATO debt because the ATO debt book is significant. I think it's billions of dollars.
Yeah.
And they want to get that down. But what they're doing is it depends on the taxpayer. And my suggestion is for people who have equity or access to funds otherwise, it would make sense to refinance the amount you owe to the ATO. Let's say you've got equity in your own home.
Mm-hmm.
If you can access like a separate loan in that to keep it just for your business tax debt, for instance, lend that to your business uses that to settle the ATO debt. You've turned non-tax deductible 11% rate with the ATO into maybe 6 or 7%, depending on whatever your own home loan rate is.
Yeah.
But that is actually tax deductible to the business if it's used for business purposes. So your effective interest rate is so much less now immediately through that strategy. I'm encouraging clients where they've got the ability to do that. Obviously, we want to get on top of that soon. You don't want to leave that non-tax deductible debt there for much longer. But look into refining that so that you're able to. Your cost of funds is a lot less.
Yeah. Yeah, I mean, that's a massive jump between the two, right? So, and anyone that's interested, that's listening, that wants to know a little bit more about that, I mean, you're obviously the best man to talk to. You know it very well. Matt, I just thought I'd finish off with, obviously very proud to be mates now for what's it been? I think it's been the best part of 5 years, roughly. I think probably right around when I first started the business.
Yeah.
Obviously, seeing you guys do unreal things. I've seen the business grow dramatically. You've moved spaces a couple of times. You're in the beautiful Mosaic building there in Brisbane. For any business owners out there that maybe they're not happy with their current accountant, want to have a chat to an accountant that is going to look after them very well, is very knowledgeable. Feel free to reach out to Ben. We'll make sure that we put Ben's details in the show notes. So if everyone wants to reach out to him, they've got his details. Very all over social media, which is awesome. So you'll see plenty of updates. The newsletters are great. I know that we get them on a regular basis and gives us a really good understanding around what's happening with the budget and just what's happening in general for anyone out there. But Matt, I just want to say thank you very much for coming on and wish you all the best.
Yeah, thanks, Colin.
Cheers.
Appreciate it. Yeah,
Easy.
cheers.